Hi, this is Scott from Contact Point Accounting, and if you're a business owner who is receiving or should be receiving on a regular basis accounting reports showing the performance of your business and you oftentimes feel confused, you should watch this. The report that seems to cause a lot of confusion that I want to discuss is called the Profit Loss Report. As an example, the Profit Loss Report might show that the business is profitable, but the business owner is oftentimes wondering, well, then where's the cash? So let's demonstrate. Okay, so a profit loss report, otherwise known as a P&L, is computed by showing sales less expenses to bring you to net income. And here is an example of a fictitious business. This is a fictitious profit loss report which covers January 1st through the 31st, and this is on a cash basis. Now there are two types of accounting reports and methods. One is the cash basis and one is the accrual basis. But for ease of information and for simplicity, I want to narrow this down and keep it simple. This is a cash basis report. So we show that there are sales of $25,000. From those sales are deducted costs of goods sold, such as items purchased to be resold, or cost of services. Say the business had to hire a contractor to complete work to finish the deliverables, to bring us to a gross profit of $16,900. And then below that we have various normal operating expenses, advertising, payroll, rent, etc. And the total expenses for that month was $10,920 to bring in a net income of $5,980. Now, a person might look at this and say, okay, my net income was $5,980 as of January 31st, so therefore on that day my bank account should be richer by $5,980. Unfortunately, that's not always the case, and here I'm going to show you why that happened. Transactions that will not appear on the profit loss report. The principal portion of a mortgage, loan, or line of credit payment. So the interest portion will show on the profit loss report, but the principal portion will not. That will show up on the balance sheet. Withdrawals or deposits of cash by the business owners or partners. So when a business owner or partner wants to withdraw cash from the business for their own personal use, or deposit cash to fund the business and keep it in cash, then those are called owner's draws and owner's contributions. Again, those are balance sheet items. Those are not going to show up on the profit loss report. Payroll tax disbursements, depending on how the payroll system is set up. So if we're talking about the month of January, yes, all payroll expenses should be recorded in the P&L report in January. However, as an example, I have a client who does not pay state income or unemployment tax until after the quarter has ended. So in this case, cash would not leave the bank account to pay for those state taxes until April. So you can see that this can also cause confusion as to the total cash balance in the bank versus the profit loss statement. The purchase of assets, such as computers. Purchases of things like computers, furniture, vehicles, those are items that are intended to last a long time, 3 to 5 years as an example, so therefore they're not immediately deducted, say, as an expense in the month of January, the date of that purchase, because they're longer term items that are depreciated. They're not expensed all at once. So going back to our original profit loss report, and I've condensed this a little bit, but again, we have gross profit of $16,900, total expenses of $10,920 to bring net income of $5,980. And again, the business owner might wonder why their bank account is not that much richer on the 31st of the month. Well, the reasons why, as an example, could be that there's $1,200, the principal portion of a loan. That is the additional cash that left the bank account to cover that loan, to service that loan. Then we had, as an example, $2,500 that the owners took out for their own use, $250 for quarterly payroll taxes, and then another $1,000 came out for an asset purchase, say for a computer. So therefore, theoretically, instead of $5,980 additional at the end of the month in the bank account, there was $1,030 net increase in cash. Okay, it's time for a little side note here. Oftentimes I hear of a strategy at the end of the year when taxes are due where a business owner is encouraged to purchase a large asset, such as a vehicle or a piece of equipment. And oftentimes, of course, in order to pay for that, they have to get a loan. In fact, a local business owner who's not an accountant or bookkeeper brought this up to me at a networking event last year. And I was glad to hear that he had the insight to comment on this. Ask yourself before getting a loan to make a purchase, to take depreciation, is this purchase going to improve my business processes in any way? Is it going to improve efficiencies in the business? Is it going to contribute to sales and hence the bottom line? Is it cash flowing? Is the business cash flowing? Can it stand on its own two legs? You know, this is a common strategy, and I understand that it sometimes needs to be used, and it's oftentimes advantageous to be used. However, you as the business owner have to ask yourself, am I fixing a short-term problem with a long-term problem? So in summary, a profit-loss report is not a cash flow report, nor should it be used to extrapolate actual real available cash available to your business on a particular day. Even your bank balance is not correct if you have uncashed checks that are floating around, as an example. So hopefully now you understand the differences between profitability and cash.